How are Treasury bond earnings taxed by states? Imagine earning interest from your investments and not having to share it with your state or local government. That's exactly what happens with Treasury bonds. These bonds are issued by the U.S. federal government, and their interest payments are treated differently from many other investments. When you receive interest from Treasury bonds, you have to pay federal income tax on that money, but states and local governments do not tax it at all. This can be a big advantage if you live in a state with high income taxes because it means more of your earnings stay in your pocket. Let's break it down. Treasury bonds are debt securities, and the interest you earn is considered taxable income at the federal level. You need to report this interest on your federal tax return and pay the appropriate taxes. But here's the good part. Your state and local governments do not tax this interest income, no matter where you live. So, if you are in a high-tax state like California or New York, you can keep more of your passive income from Treasury bonds compared to other investments that are taxed at both the federal and state levels. Now, if you decide to sell your Treasury bonds before they mature, any capital gains you make are also taxed at the federal level. These gains are usually taxed at the same rates as other long-term or short-term investments, depending on how long you held the bonds. If you hold the bonds longer than 1 year, you pay lower long-term capital gains tax rates. If you sell within a year, your gains are taxed at your regular income tax rate. But again, most states do not tax these capital gains from Treasury bonds either. For passive income investors, this tax treatment makes Treasury bonds very appealing. Because you don't lose a chunk of your earnings to state taxes, your after-tax returns are higher. You can also put these bonds inside tax-advantaged accounts like individual retirement accounts or 401(k) plans, which can further delay or reduce your taxes on interest and gains. To sum it up, interest earned from Treasury bonds is taxed by the federal government but is exempt from state and local income taxes. Capital gains from selling these bonds are also taxed federally but usually not by the states. This tax setup makes Treasury bonds a smart choice for passive income, especially if you want to keep more of your earnings in your own pocket. Planning your investments with this in mind can help you maximize your returns and keep your tax bill lower.